All right, everyone, thank you very much for joining us today for another great edition of our educational webinar series. Today, we're very pleased to welcome on Ricardo Ferrer with Pier Capital Partners. A little bit before we get started, just want to kind of go through a few housekeeping items, explain who Advanta is, and then we'll get you started. Please note that everyone's mic is muted, so if you do have a question, please do type them into the chat box. I will be moderating those as they come through. So again, if you do have any questions, type those into the chat box, and I have attached the slide deck as a handout to this presentation, so you can grab the slides right there if you would like them. My name is Alex Perny. I'll be moderating for you today with Ricardo being the main presenter. I've been with Advanta since 2012. I've had a lot of experience doing all sorts of self-directed IRA investments with clients. I've done everything from private placements to startup companies to commercial lending to single-family homes, to all sorts of interesting things. I've been involved in almost 1,200 individual investments the first part of my career with, again, all sorts of interesting alternatives and retirement plans. So if you have questions on that side of things, I'm more than happy to answer them for you and probably have some experience in doing them hands-on as well. A little bit of a disclaimer as well: Advanta IRA and our employees do not provide investment, tax, or legal advice, nor do we endorse or promote any investment products. All informational materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A little bit about Advanta IRA. We're a self-directed retirement plan administrator servicing clients nation and worldwide. Probably need to update that slide. We have almost 20 years of self-directed IRA industry experience. Any cash that is held with us, of course, is FDIC insured, so you're not giving up anything. If you'd like to go a more alternative route with your retirement plan investing, we offer dedicated account management for any account that's here. So if you have an account, you always have a singular point of contact, and a proud milestone is that we have crossed into the threshold of over $2 billion of assets under administration. So we're really happy to have had that growth over the past 20 years, and we administer currently almost over 8,000 individual IRA clients' accounts as well. So if you have questions on doing this, we certainly do have the experience to back up the service that we do provide. And with that said, I will go ahead and just a few other items real quick. You can invest in self-directed IRAs into many different types of alternatives. Granted, we will be talking about lending today, but it's not simply just that. You can do anything that's basically real estate related, mortgages and notes, private placements, precious metals, foreign currency, futures, and a lot of other things. But essentially, we will be focusing on the private lending aspect of that today. As well. See a few questions filtering in. I'll just address those real quick. So more to me. Again, yes, there is a handout. No, there is no CPE offered for this. And again, we administer all sorts of different accounts, not just IRAs, but we do 401ks, Roth 401ks, defined benefit plan, record keeping, HSAs, ESAs, simple IRAs, SEP IRAs, and of course the Roth and traditionals as well. So again, before I turn the slides over to our presenter today, if you do have questions, make sure you do type those in. I will pepper those in when we have a slight break, so just make sure that you are asking those questions and we will get them addressed as they come through. With that said, let me just make sure. Okay, Ricardo, take it away from here. Thanks very much for being with us today.
Thank you for inviting us on. I do appreciate that. I trust that everybody had a good holiday season as well as a New Year's. My name, as was mentioned, my name is Ricardo Ferrer. I'm the Chief Investment Officer over at Pier Capital Partners, and we're going to be discussing private real estate lending. What exactly is it? Why do we do it? And why you should have a portion of your investment portfolio dedicated to doing some lending. Regarding myself, I have degrees in finance and economics. I've been a real estate appraiser. I've been a financial advisor in the CRPC with Merrill Lynch, and currently I'm an active wholesaler lender with my private capital and other investors' capital, as well as a real estate investor. Our company, we manage a social economic impact fund, and what that means is that we improve real estate and we try to attract new business and investors to the areas that we participate in. In the improving real estate section, we try to increase property values, which in turn supports jobs. When an investor comes to us and gets a loan and basically rehabs a property, it improves the value of that property. It supports the jobs in that community. It also increased taxation because the property value now has to be taxed at a higher level. Then that means that the school system receives more money, so they improve the schooling education. In turn, they also have more capital for the police and fire department, which in turn makes that community safer. As far as attracting new jobs and new businesses and investors to the areas, we obviously look to create new jobs, which will in turn increase wages to the area. Will hopefully also improve amenities, where that's shops or restaurants to the area, which increase the convenience for the residents of that community. On the right-hand side, you're going to see our ecosystem, which goes from right to left, which shows you basically all the different industries that we impact as we create loans for borrowers that want to do rehab of properties. And the other numbers that you see there is basically our entire socioeconomic impact over the life of our company for the loans that we have created. So without further ado, let's talk about what exactly is private lending. In its shortest form, it's basically private capital, and it's usually supplied by individual investors, hedge funds, or family offices. In the individual investor side, it comes from individuals such as yourself that either have a self-directed IRA or a solo 401k or large funds that you currently hold in your bank account and savings and checking, or it comes from hedge funds or family offices on the institutional side that manage typically between 100 million plus, and they usually dedicate a portion of their portfolio to hedge against some risk that they may be exposed to in other more risky investments. What are some features that come across with private lending is that these types of loans are usually non-recourse, and I'll explain a little bit more about that here shortly. They're fast moving. These loans typically close between 1 to 10 business days. It's a low doc type of loan as well. The loans are short term, meaning 12 months or less, and typically the rate that they offer are between 10 to 14%, and they're usually interest only. As far as the non-recourse part is concerned, let's talk about that in relation to how owner-occupants typically get a loan from the bank. When you reside in a residence, you got a traditional conventional loan. Let's say that you went to foreclosure and there was a deficiency. The property you owed $500,000, but the house is worth $400,000. That means that when the bank takes that property from you, that $100,000 deficit, they are technically allowed to go after you personally for that deficit. That's a recourse loan. On the hard money side or private lending side, it becomes non-recourse, which is exactly the opposite of that. So let's say that we did a loan, it was a bad loan, and we lent out $150,000 in a property that today is worth $100,000. The client, for example, let's say that he was no longer able to make the mortgage payments. We had to take the property back from him. We sold the property, but we're only able to recuperate $100,000. That $50,000 deficit, we cannot go after. It's just a wash for us. Fast moving, these are loans that close in 1 to 10 business days. I'll go over examples of that in which type of loans those would be. Low docs, different than a conventional FHA or any other type of Fannie Mae type loan. We're not going to require your DTI, your debt service ratio. We're not going to require W-2 forms. We're not going to require your tax returns. We're not going to require an appraisal. And that goes back to that we have to have these loans closed quickly. So who uses these types of loans? Typically just one type of person, and that's going to be your real estate investors. These are individuals that are looking to rehab distressed assets and sell them or keep them for the rental portfolio. It's also the same investors that are either acquiring properties through REOs or online auctions. This might be an individual that has a really good deal in his hands, but the way that he's structured it, he's got a short period of time to be able to close on this deal, and he's deciding to get to work on a long-term financing. So that means is that long-term financing might take 30, 45 days to close. This deal has to close in the next 10 days. So he engages a hard money lender. We close the deal, and then he has the timetable to now wait for long-term financing to come in and then take our loan out. That would be the example of bridge financing. And lastly is a tax deed sale. I'm from Florida. I'm not sure how many of you guys are here from the South, but in the county of Orange, we have tax deed sales once a month. And what that basically is that when you're delinquent on your real estate taxes, after a certain amount of years, the county basically puts your property up for auction so they can recuperate the money that's owed on the real estate taxes. If you go to the auction and you win one of the bids, one of the properties that you bid on, those properties have to be funded within 24 to 48 hours. So unless you have that cash available in your checking account and readily liquid, you will typically have to engage a hard money lender to be able to fund that transaction. So how exactly does this work? And I'm going to give you guys a real life scenario that we have with a client of ours that acquired the property on the top left-hand side, the yellow form, which is done, I believe it was in the first quarter of 2021, and he just sold it in the first quarter of 2022. So he actually held this loan out for almost its full term of 12 months. So on the left-hand side, you're going to see the specs of the property. So the property was purchased for $135,000. However, the property was worth, as it was, $150,000. The rehab budget was $75,000 for the property. The ARV of the property was $350,000. We analyzed the property, underwrote it, and we were able to offer him a $189,000 loan on something called the LTC. For those of you that do not know what that is, LTC is the addition of the purchase price plus the rehab. And the loan to cost on that one was 90% of that value, which is $210,000. We were able to give him a $189,000 total loan. From that 189, we subtract the $75,000. We keep that as a rehab budget holdback, and then we actually give him only $114,000 for the actual purchase of the property. The interest rate that we offered him was 12%, and the term of the loan was 12 months. So let's look at the risk over the life of this particular loan. And I have these red arrows and down arrows just to show that the risk for the borrower goes up as time progresses, and the risk of the lender actually decreases as time progresses. And as I go through this example, hopefully you'll get what I'm talking about. So as we said, the borrower bought the property for $135,000. Our purchase loan to him was $114,000, which means that he had to come to the table at closing with $21,000 worth of down payment. Now, as a lender, we obviously collect points on the front side. So we charge 3 points for this particular loan. We charge $5,670. We charge an origination fee, and the owner was able to purchase the property. There's carrying costs, which are basically the costs that he's going to incur during the time that he's rehabbing the property. So the mortgage that he's being charged is $1,890 per month. He's got utilities costs, water, electricity for the repair of the property. That's going to be about $125 per month. He is required to have insurance. In our specific case, he has to have builder's risk insurance. That costs him about $1,500 for the year. And he's got to pay the property taxes for that year that's holding the property, which add up to about $2,000. Then you got the disposition side of the property. Once the property is rehabbed, you have to sell it. So once you find a buyer, you're going to have to take care of two things: your title costs, which are usually going to be about $1,250 for this particular property, and you have to pay your realtor commissions, which is going to be your seller representative and also your buyer representative. If you're a good negotiator, you might get this lower than 4%, but for this purpose, our client was able to pay 5%. His total out-of-pocket expense for this transaction for the 12 months that he held the asset was $74,350 out of pocket. Now, the reason why I said that his risk goes up is that keep in mind that the longer that you hold the property, you're always going to have these monthly expenses. What you're doing is you're getting closer to that after repair value of the asset. That means that you're actually eating away your profit the longer it takes for you to turn this property around. On the lender side, let me show you how our decrease goes down. So as I mentioned, we gave the lender or the borrower, $114,000 for the purchase. That means that we technically bought this property for $114,000 that is worth $150,000. That means that we technically, day one, have an equity in this property of $36,000, which means that our risk exposure is 76%. Once the asset is fully rehabbed, we know that the valuation or the value at that time of the asset is going to be $350,000. At that time, we will have already deployed the full $75,000 of rehab, which means that we will have a total exposure at that time of $189,000, which means that now our equity basically went up fivefold. Now we have $161,000 in equity in the real estate, and our risk exposure has actually decreased to 54%. We also have some additional risk reducing factors, because remember, we did loan out a total of $189,000, but we did collect points in the front side. That means that we decrease exposure from 189 by 5670 by the origination, and then by the total amount that we collected over the 12 months in mortgage payments, which means that at the end of 12 months, our risk exposure net is actually $159,150 or 45.47%. So the longer that the borrower keeps this loan, the safer it is for us. Now let's talk about the profit and return over the life of the loan for both the borrower and the lender. So the actual real price at which the borrower was able to sell the property was $345,000. They had a loan with us of $189,000. They had total out-of-pocket costs of $74,350. Once you net all that out, his net profit for that transaction was $81,650. Now, if we look at how much he had out of pocket, he had a really good return, 109.82%. This is very abnormal in real estate, by the way, fix and flips. But I want you also to know that this return that he has is because he held that loan for 12 months. Had he held it for 3 months or 4 months, that return will actually be higher, because that means he would have saved 8 months plus of mortgage payments as well as utility payments. On the lender side, we had the sales price of $345. We had a total loan of $189. That means that we had an equity at that time of $156,000. So let's talk about all the income that we received for laying out $189,000. We had points of 5670, origination of 1500, interest only payments of 22,680. That means that we made a total income over those 12 months of 28,350 for the 189 that we laid out. That means that we had a net return of 15.97% in this particular loan. Now, obviously for us, when we hold a loan in portfolio, that means that we hold it in our balance sheet. This is the most that we can make. If a client pays us off early, let's say month 3, to give you an example, that means that we're going to make roughly about 6 or 7% because we're going to collect the 3% origination points that we collect, the 1,500 origination fee, plus we're going to collect 3 months of interest payments at 1% per month. It gives us roughly a 6% to 7% return. Now, it is beneficial for us, believe it or not, that a client actually gets out of a loan sooner rather than later. And the reason is that when that money comes back into the fold and we're able to go ahead and lay it out again, we can once again origination fees and points. So if we talked about the 6% that we're collecting up front for holding a loan for 3 months, and then we have a 4 transactions instead of 1 over the year, that means that we as a company are generating 24 to 28% on that money. So why lending versus other investments? The number one thing that we look at with not only our capital, but the investors' capitals that we manage is we have to have control over risk. And the ways that we do this is by price risk adjusting and obviously the loan to value and loan to cost. And let me explain that a little bit further. I'm going to use price risk adjustment because we're all living through it right now. Post-COVID, we've had the Federal Reserve be very involved with that's decreasing rates, or currently in the market rates that we're in, increasing rates. So a lot of the comps that some of these investors are utilizing, they're old, they're more than 6 months old, and they're going to show basically pricing that's no longer correct. We've had a correction due to the raising in rates in inflation of roughly about 20 to 25%. So if a client comes to me and shows me a property that they have under contract that's for $500,000, and the comps that they're showing me are from back in April or March, I'm going to say this property is not worth $500,000 anymore. This property is probably going to be worth more like $400,000, and that's what the price risk adjustment is. I basically look at the marketplace, what's going to happen. We're going to hold this loan for the next 12 months and have to make sure that the capital that we deploy is safe. Once I come up with a valuation of what that property really is worth in today's dollars, then we go ahead and apply the LTV and LTC guidelines to that. Another thing that we like about lending is that we can obviously control to a certain degree the returns. We can assess different points. In a market where there's high demand and a high access to cash, we'll probably decrease the points to somewhere in the 2 points range. If it's a situation where there's high demand and low capital, we'll probably increase the points to 4 points. Interest rate, same thing. Depending on how fast we have to close, the experience of the borrower, FICO, myriad of other variables, we may be somewhere in the 10% range, we might be as high as 14%. So we have at least some control of how much we're going to charge up front and during the life of the loan to the actual borrower. Another portion that I like about it is arbitration. What that is that once you're able to generate between $5 to $10 million plus in loans on a monthly basis, you're able to reach out to something called your note buyers. These are institutions that actually sell to Wall Street, to pension funds, to bond fund managers and the such. So what arbitration is the following. Let's say that I originate a loan for 12% interest only for a term of 12 months. I contact my note buyer and they're going to buy that note from me at par. At par means that if I originate a loan for $189,000, they're going to give me exactly that, $189,000 back. The arbitration happens when they say, we will buy that loan off of you for 10% yield. That means that I originated at 12, they're buying it from me at 10%, and that 2% that is left over there actually gets kicked back to us so that we can stay active with the loan and actually help them service it. So that for us is a phenomenal thing. Also, the extra strategies. We would like to have contingency plans in place. What if something negative happens? We already talked about the selling of the notes. That's something that we can do. We also do something called deed in lieu, or we can also do a foreclosure. Now, knock on wood, thank God, we haven't had the need to foreclose on a client. However, we have had a couple of deed in lieus, and that's the avenue that we prefer to utilize so we don't damage the borrower. What a deed in lieu basically is the following. If a client goes on and gets involved in a project, something happens, a family emergency, where they can no longer carry on with the project, and now they have to stop making the mortgage payments, they're basically in default. They either reach out to us, or we eventually reach out to them, and we try to negotiate what's called a deed in lieu. What that is we ask them to just sign the property over to us, and we forgive the loan. And the reason is what I covered before in the example. Remember, If the client bought the property for $135,000, it was worth $150,000, but we were into it for $114,000, it makes all the sense in the world for us to go ahead and take that property from the client, not hurt him at this time, and just have him be able to, in the future, later time, either come back as a borrower or just go ahead and get into another transaction with a different lender. Once we take over the property, we have a couple of options. We can do wholesaling, which that means that we are owed $114,000. We can very easily sell this property for $125,000, which is $10,000 cheaper than the first investor. The second investor gets a discount of $10,000. We get our $114,000 back, plus we make an additional $11,000 for ourselves and the investors. The other alternative, we can very well just take that property in-house, rehab it and sell it, and just partake of the larger portion that we talked about, the return of $80,000 or so. So reason why we're also in lending. This is probably the main and most important reason why we are in lending. This is the volatility index, and this measures basically the volatility of the stock market. We don't like to be in a situation where there's a lot of fluctuations in the market. It makes it hard for us to predict what we can generate. It makes it hard for us to be able to have clients on board because you may or may not make money. We like consistency. So we opted to just be part of the housing market. Why? It's a much smoother scale. As you can see, this goes back roughly 50 years, and housing prices have steadily and consistently gone up. Have we had corrections? Yes. We had the credit crisis that we had in 1987. We had the crisis that we had in 2008. And now we have a correction that's occurring because due to the PPP program, the SBA, COVID, there's been a lot of money that's been pummeled into the economy, and rates have been fluctuating thanks to the Federal Reserve just to try and control some of the inflation. So what we're trying to avoid is the peaks and valleys. So as the Fed comes in and they raise interest rates and they implement some monetary policy, you're going to have these peaks and troughs that happen all throughout the economy. That's why most individuals that invest in the stock market, they usually have a strategy to invest for 10, 20, 30 years because financial advisors are not equity traders. They're not in there getting in and out of trades on a day in, day out basis. They're just having in for the long haul. So what they recommend for you to do is just get in the market, take the wallops, takes the ups, takes the down, look at it 10 years down the road, 20 years down the road, and hopefully you have a profit. That's not what we want to do. What we want to be is this diagonal, very steady line that comes across where we can say we can definitely generate this return for the client day in and day out. Now, I mentioned the Federal Reserve. That's the number one culprit that we currently are dealing with and we have been dealing with since 2001. The Federal Reserve is comprised of two branches primarily, which is the Board of Governors as well as the FOMC. And what they're able to do is they're able to impact the money supply as well as the cost of capital. They do it through three different tools. The first one is reserve requirements, and I'll make this a very simple example. For those of you who have a commercial bank account, whether with Fairwinds, Bank of America, Chase, SunTrust, etc., when you deposit money in there, let's say $1,000, the bank has to have a deposit with the Federal Reserve. When the Federal Reserve wants to stimulate the economy, the reserve requirement is very low. So if I deposit $1,000, the Federal Reserve might say, hey, your reserve requirement is it's going to be $5 of that $1,000. That means that the bank has $995 through which they can originate conventional loans for those owner occupants. The opposite is also true. If they want to basically pull back on the economy or curtail the economy as they're doing right now, they will increase reserve requirements, which means that that $1,000 that I deposited, maybe now the Federal Reserve requires me to have with deposit with them $500. That means that there's less money now that the commercial bank has to lend out to basically originate conventional or traditional financing. Another way that they impact the money supply, they do it through open market operations. When they want to stimulate the economy, that means that the Federal Reserve will go through their member banks, through the Chases, the Bank of Americas, the SunTrust, etc., and they'll go out to the marketplace and they'll buy equities and bonds. What that does is that they're trading cash that they have in their accounts for these equities and debt securities. That money goes into the accounts of banks. That means that now they're replenished. And then what they'll do is that they'll decrease the rate of discount. That means that the rate at which the commercial bank is borrowing money from the Federal Reserve goes down, which by default gets passed on to you, which is the reason why a couple of months back, we had loans that were being offered at 2%, 3%. Unfortunately, that's not the case right now because as we have all been privy to, the Federal Reserve is currently in an increasing interest rate environment. Now, there's a third impact that this has. When the Federal Reserve raises the discount rate, it impacts directly the bond market. The bond market are the ultimate buyers of basically all mortgages that are generated, whether it's conventional, FHA, even the private loans are generated by companies such as mine. They are all bought by these mutual fund managers that deal around bonds. So the way that a bond works is a bond is issued at something called par. Par is basically $1,000, and it's a debt instrument. Now, when that instrument is issued, it's going to give you a fixed yield. Let's say that it's $100. So a bond that's issued at $1,000 is yielding me $100 per year, paid in semi-annual payments of $50. That means that that bond, the interest rate that's providing me is 10%. So when the Federal Reserve drops the interest rates, it makes it phenomenally good for the bond buyers, because that $100 stays the same, but now the yield has decreased. That means that that bond might be yielding now, as far as the interest rate, maybe at 5%, but the par value stays the same in that it's supposed to be at $1,000, but now it's yielding me $100. So 5% of what figure equals $100, and that's going to be $2,000. And now this bond has gone up by double its amount just by the fact that the Federal Reserve affected the interest rates. The opposite is also true, and it has a deeper impact than this one just had. If the Federal Reserve ends up increasing interest rates, then what it does is that it increases the rate of the bond. So now let's say that the rate is 15%. My yield's still the same as far as the $100. So 15% of what figure yields me $100 per year, and that figure is $666. So what happens is that Wall Street sees this occurring, and they say, listen, I'm thinking capital losses in a fund that's supposed to be very conservative, supposed to just be an income base, because mostly retirees, pension funds, and elderly are participating here. So I can't take these 33% losses on something that's yielding me possibly 5 or 6%, because it's going to take me 6 to 7 years to recuperate. So at that time, they stop buying notes. And that's what we're seeing nowadays. Banks, when you go to a bank nowadays, most of them are doing what's called portfolio lending. That means that any loan that they originate, because now they don't have a note buyer on the backside who they can transfer that risk over to, now they have to hold those loans in their balance sheet. So what that means is that if I'm the one originating the loan, and I know that I'm going to have to hold that loan in my balance sheet for the duration of the loan, I have to make sure that those loans are exceptionally good. So if you go to your bank nowadays, you'll notice that your FICO requirement has gone up from what it used to be a year ago. You'll realize that your interest rate is higher than it used to be a year ago. They may require you to have a better DTI, or debt to income ratio. They may also require you to have a very healthy debt service ratio. They may require your W-2s to be very good, as well as your tax returns. So those are things that will happen in this type of situation. So how do we navigate when this whole thing is going on? So we use something that everybody else uses when you do investment, which is diversification. We deal with over 6,000 real estate investors. We're spread across 9 different states, and we invest across a series of asset classes, which would be single family residences, small multifamily, and small commercial. Risk mitigation, as I mentioned earlier, we sell notes at par to our note buyers. So it's a way for us to pass on that risk to somebody else over in Wall Street. They usually buy our notes on a weekly or bi-weekly basis. And we still benefit from the arbitration that I talked about earlier. So if we can generate loans weekly, that arbitration just keeps piling up on the backside. So what that means is that, let's assume that our fund has $10 million and we're able to loan out $10 million on a monthly basis. That's our capital. Since we're getting these notes bought on a weekly basis, that means that our $10 million fund operates as if it were a $120 million fund, because we can deploy $10 million, get $10 million back, deploy it back again, and we're still making that 2% on the background of that $10 million, which adds up to about 200 grand per month, which is pretty good. That's going to be roughly, if my math serves me right, $2.4 million just in passive income of a $10 million fund. That's a 24% passive return just on that capital, without counting the origination fees and the points that we charge up front, and any monthly payments that we may be collecting during that timetable. Lastly is contingency plan. As I mentioned before, deed in lieu and foreclosure is a way that if something were to go awry and we have no other way of solving it, these are things that we can do. In case of a deed in lieu, we take the property over and can go ahead and wholesale it to a different investor, or we can bring it in-house and sell it. So these are the ways that we navigate, and we make sure that we protect our investors' capital. Some of the properties that we lend on, that you can see it physically, is we lend in single family, anything between duplex, triplex, and quadruplexes. The small level multifamilies up to about 30 units that we lend, and we also lend in ground up construction with a single family up to small level multifamily. Some of the properties that we have done, here's a property that we did over in Fort Worth. It was a brand new construction. Loan amount was $490,000. Build cost was $405,000. Market valuation was $645,000. Then you see the interest rate, the loan sold at the coupon. So we had an arbitration of this one of 2.5%. A property here that we did locally in Orlando, same thing. Loan amount $285,000. Loan ARV was 65% of ARV. Interest rate was 12%. Monthly interest rate was $2,853. It was a 12-month loan, and we were very well collateralized since the property sold for almost $600,000. So we were close to be a 50% roughly LTV on that one. Lastly, we did another one here in Cape Coral. This was a 30-year financing. We were able to get the client $123,000. They were just doing basically a cash out refinance. The value of the property was $394,000. The assets for us, based on the loan that we did, was 50%, so we very well collateralized on that one as well. Interest rate was 6.25, and it was 30-year fixed loan on that one. So as I mentioned in the beginning, we do have a fund. Our fund is an SEC registered 506c fund. It has the size of $50 million. We are actively raising capital for it. Investors that want to participate of the fund can invest with us up to 10 years. Minimum investment is $25,000. We do offer 2 returns. The first one is a preferred fixed return of 7%, and we have a fund participation of 35% of net profits. That allows you to participate of the arbitration that we create, and obviously the selling of notes that we sell, get the money back and reissue. With that, that concludes my presentation. I would be more than happy to answer any questions that anybody might have. Alternatively, you can reach me directly. My direct line is provided here on the screen, 561-307-3002. You can also reach me via email. And if you have any requests for information, you want to learn a bit more, you can feel free to go to our website, piercapitalpartners.com.
Yeah, Ricardo, I really appreciate you being on with us today and talking about how these types of loan investments can work. I guess more to some of the question that I had that wasn't necessarily posed. We didn't have a whole lot of questions today. Would be centered around things like, you talk about the risk of these things, but have we seen a large increase in foreclosures coming over the past few months? And what kind of things can people be aware of looking to get into note investing, especially now when it's probably perceived that foreclosures are going to increase, maybe not to the percentage that they did during the Great Recession in 2008, but obviously with a looming downturn, maybe not necessarily a recession, but at least some type of market correction, what people can look for to try to protect themselves in that. Is it mainly to do with loan structuring and deal origination? Is it the numbers? What are some of the kind of big factors that people can look to in protecting themselves in this type of market?
Sure. So the very first factor to look at is the inflation rate. As lenders, we are in the forefront of anything having to do with real estate. So the 2 things that we look at primarily is going to be the inflation rate and what the Fed is doing. So inflation rate in the US traditionally lingers around 3 to 5%. We hit a peak of almost 9%. So we know that the Federal Reserve has to be acting until they can bring inflation rate down to those numbers. That adds up to roughly a 40% correction. So if, for example, at the peak of the markets, which was, I would say roughly March of 2023 was basically the absolute peak of the market. We know that from that standpoint, the Federal Reserve is going to be very aggressive with raising rates. So we know that from that high, we have to calculate a 40% decrease of that high. So any asset that at that time was worth $500,000, we're going to knock out probably a 40% after it's all said and done, or a $200,000 decrease. So we're expecting a correction in the real estate market of somewhere between 30 and 40% across the board. So that's the number one thing that we have to look at. The most difficult thing and the most important thing, once you understand those 2 parameters, that the Federal Reserve has a lot of impact in the real estate market because they, 1, impact the money supply as we discussed, and they also impact the cost of capital. The other thing, and this is where I see most investors, and believe it or not, a large number of companies failing, is that they do not know how to properly value an asset. This is where I have a competitive advantage because of my appraiser background. If you're unable to properly value an asset, hopefully you've been more conservative than lofty. So it's better to loan less than loaning more. So if you're going to be incorrect in your favor, not in favor of the borrower. But that is the number one thing that I would tell individuals. You have to be aware of what's going on with inflation, be aware of what the Federal Reserve is doing, and you have to get good, if you're not already, at being able to property value its assets. That means before rehab, be able to value exactly, not just take the word of the borrower, what it's going to cost to truly rehab that property, and also be able to work out what the ARV or after repair value of the asset will be once it is repaired.
So when you say, maybe a 25 to 30% reduction in the market, are you talking about sales or value specific to that point?
We are talking about value, because
Okay.
by default, the lack of sales, which means that the lack of demand, even though there's an increasing supply, is going to by default just correct the market southward. So their function, there's essentially a function of each other.
Yeah, no, just want to make sure that we clearly define that. And then, we're talking about rising interest rates. So what is the kind of the corollary between a rise in the, the discount rate that the Fed puts out and, obviously then that trickles down to, let's say conventional financing? What kind of increase do you see on the private lending side of things when the Fed, like if they have a 75 basis point increase, like we've seen, time and time again, although the last one was 50 basis points, correct? It was 50 was the last one.
Yeah, until we start seeing 0.25, we're not expecting any slowdown.
So what exactly does that look like for the rates that are charged on the private market as opposed to, what is charged, if you just go and, if someone, Jane Smith walks into Wells Fargo and gets, 6.5%, 7% on a 30 fixed, what does that look like for the, for the hard money or the private money that's coming out? What kind of corollary increase do you see in the rates that can be charged on the market that you're operating in?
Sure, good question. So it goes back to the bond market. Remember, the bond market are the ones that basically buy our notes. Excuse me. So what's happened is that before this whole situation with the Federal Reserve, we were having our mortgages or our loans that originated being bought from us 8%. So we had pretty good arbitration, and we were originating somewhere between 10 and 14%. Those same note buyers nowadays are still active, and the ones that we deal with, just to make it clear, even though the US market is not buying, some of these note buyers that we deal with are Canadian money, some are Japanese money, some are European money. So they're not having the same difficulty that the US is having right now in correcting the inflation rate. So what happens is that they change the hitbox for us. So they're saying, hey, we're willing to buy your loans, but now we're going to buy them somewhere between 10 and 12% once we underwrite your loans to see what kind of quality of borrower you have. So they dictate to us basically at what rates we can lend. So if a note buyer is telling me, hey, I'm not buying anything less than 12%, if you're not originating at 12, I'm not buying your notes, and I still have a demand for loans that's coming into my pipeline, that means that I have to, at a bare minimum, originate loans at 12%. If I want to make a little bit of scratch on the backside, that means I have to originate at 13 or 14%. So that's basically the trickle-down effect that we're seeing. But we're more directly impacted by the bond market's fluctuation than we are by the Federal Reserve increase or decrease on the on their discount rate, because that directly impacts your traditional homeowner occupant borrower.
Gotcha. Yeah. Now with regard to looking at the, increase in the, discount rate that the Federal Reserve kind of comes out with, it's always going to be pretty much, a direct relation to the inflation rate. Now there's a few different markers that people can look at. Most commonly kind of that people look at is the CPI. If you're looking at stuff and trying to make like at least an educated guess of where Jerome and the Fed's going to go with something, what would you say are some good resources that people can do their own market research on besides just waiting for CPI numbers to come out? Are there any other kind of good bastions of information that are out there? I'm kind of a sucker for research, and besides just looking at some general numbers, what are some other things out there that people can look at to help guide them try to be a little bit more ahead of the market when doing research?
The St. Louis Fed website is phenomenal. You can find literally every chart on anything you can ever think of. And I have it on my other computer, so unfortunately I don't know off the top of my head. I have it in my bookmarks, but it's the St. Louis Federal Reserve. It's called Fed, F-E-D, and they basically provide all the charts you can think of. The charts I utilize today, as a matter of fact, when we talked about the VIX and we talked about the house pricing index, they actually come from the Fed. So for those of you that have the slides, I believe on the top left-hand side and the bottom right or the bottom left of the slide, you may have the web address for the St. Louis Federal Reserve. So that's a great resource for you to utilize. Unemployment is a very good thing. Actually, before I got into this webinar, I just received an email letting me know that I believe it was Goldman Sachs is going to lay off about 4,000 people. Amazon's going to lay off 14,000 people. JP Morgan Chase is going to lay off some people. Morgan Stanley's laying off people. So the layoff unemployment is also a big indicator, because as people become unemployed, you're going to have less expendable income be available for people, for businesses like restaurants, movie theaters, Disney World, if you're in Disney, if you're in Orlando, for example, travel, airlines. So it starts impacting so many different industries when people just aren't working, because now they have to make tough decisions. Do I put food on the table, pay the mortgage, pay the house, or do I risk it and let me go out for a dinner with the family, let me take them out to a movie, let me take them out to a theme park? So you're going to see that, you're right, the consumer price index is a good indicator. Unemployment is also a good indicator. The inflation rate is a good indicator, so we can see exactly if we're too far out of where we should be, because that's correct. So those are sources that usually would look at when it comes to making some decisions.
Yeah, great. So now with regard to kind of like what's, that's great for doing research, but at least with what's currently going on now, it was nice that, there was only a 50 basis point increase previously as opposed to the last four, trailing that were 75. You kind of indicated that you see something around March kind of being the inflection point for all this. So, what kind of things would you, say, if we're going to hit that kind of, turning point, maybe, beginning of Q2 of this year or something like that. On the backside of that, it's easy enough to say, okay, if you're lending out in a more volatile market, you raise your rates, you increase your origination, try to protect you so that way you have, better ratios and better LTV and everything like that. But, when the market starts coming, on that, trajectory of, it hits a, again, inflection bottom, it's, kind of that point to where that bell curve starts to either level off or go back the other direction. What are some things that people do at that point so that way they're not kind of positioning themselves to have something that's overpriced in a particular market?
Well, in that sense, you have to look at comparable sales. That's the only indicator if you want to look at what is that asset really going to be worth. The other information I've been discussing is just to be able to correct those valuations in a market that's volatile like we're experiencing right now, where it's a direct impact by the federal intervention to the marketplace. But your best indicator is going to be your comparable sales. So if you're looking at what an asset's going to be worth, you have to see, okay, what is the most recent sale? And most appraisers will not go more than 180 days back to utilize for the most recent sales. And the most recent sales have been before the movement in the Federal Reserve, for example, then I have to take a conservative approach and say, okay, maybe a 25 basis point decrease or a 50 basis point decrease in the scope of what I think the Fed is going to totally decrease might signify a 5% decrease from the valuation or a 10% decrease from the valuation. Unfortunately, there isn't a set equation. This is more of a science rather than a factual thing that we do. So we have to just kind of just be on the conservative side and utilize whatever data we can to make it make sense and communicate it according to the borrower as to why we are giving him a price risk adjustment.
Yeah, and obviously the problem with that is that, sales are always going to be contractually negotiated on, basically 30 to 45 days previous of what the actual market is. So there's always a little bit of a guessing game in that and trying to, hone in your data, try to figure out, what's going to be coming down the pipeline. With stuff with home sales is always kind of a tough one, at least that I've seen in my career, because, coming into, the alternative asset space in, the beginning of 2012 and of 2011, we were, beating our heads against the wall trying to get the REO, getting, the big banks like B of A and Chase to offload their REOs to our clients, and just, seeing the market continue to fluctuate because they, just didn't want to offload these and, have a glut and drive down the prices of their REOs, while at the same time, they were having vacant houses and neighborhoods and those types of tranches were also directly affecting, property values when there's just, these, quote, zombie houses sitting around. So always kind of tough stuff to look at. And I, really appreciate your insight into this because, again, my career kind of started toward the bottom of it. And, it's kind of been more or less a 45-degree angle on that pricing chart since then with a few hiccups and the like. So, seeing how some of that kind of stuff can correlate to this. And obviously, a lot of, our investors aren't, my age or your age, and, have had a lot of experience with this, but, it's definitely kind of interesting to see how this is all going to play out. So, I really appreciate all the great insight that you've given us today, Ricardo. Are there any other kind of, salient points that you'd like to bring to anyone's attention before we get going? And we did have one question that I wanted to make sure got answered before we get out of here. I know you probably know this answer better than me, but someone asked, can you define what a qualified investor? I think they meant maybe accredited investor more specifically. I can't always remember at the top of my head what the metrics are for that.
Yeah, so an accredited investor or qualified investor is somebody that has a net worth of $1 million or more. And if it's an individual, they have to have an annual income of $200,000. If they're married, they have to have a joint income of $300,000.
Yeah, and also to that point, that accreditation does extend to qualified plans. So let's say you had an IRA or a 401k or something that had, less than that in it. But if your total net worth, exceeds that, or you do meet the qualifications for that, a retirement plan by default does accreditate with you personally. You don't have to have $1 million IRA or $250,000 IRA to gain that. It bases it off your personal accreditation of the deployment of those funds. So
It's your net worth. So just keep that in mind. It's your assets minus your liabilities. That's your net worth.
Yeah, exactly. Excluding your personal residence, right?
Yes, correct.
Yeah. All right, great. Well, Ricardo, I really do appreciate your time today. I know everyone's always busy, and the one thing that we can't get any more of, no matter how much money we have, is time. So again, I always really appreciate when people take time out of their day, which is the one resource we can't get any more of. So again, really appreciate that. If anyone has any questions, they can reach out to Ricardo on what he has going on. If you have any questions regarding IRAs, retirement plans, or any other fun type of alternative investments, please feel free to reach out to me. I'm always available. Ricardo, again, thank you very much for being with us. And with that said, we'll let everyone get back to their day. Thank you very much.
Have a good day.